On one hand, some are saying that new all-time highs could be around the corner, yet on the other hand, some are saying that famous 4-year Bitcoin cycle might actually be broken. So that brings us to the question, is the famous 4-year cycle finally dead? Let's find out. Now, before we answer the question about the 4-year cycle, let's find out why the 4-year cycle even exists in the first place. So, about every 4 years, Bitcoin goes through what's called a halving. Now, during the halving, what happens is that the rewards which miners get for creating blocks, well, that gets sliced in half. It's actually built directly into Bitcoin's code, which means that it can never be removed or changed. Think of it sort of like a factory that suddenly produces half as many products. If the demand stays the same, or even grows, well, the supply becomes much, much tighter. Historically, this has been one of the biggest drivers behind all of Bitcoin's bull runs so far. The most recent halving happened back in April 2024. That's a couple years ago now. But this 4-year cycle has come with something we've never seen before: US spot Bitcoin ETFs. Now, these ETFs hold real Bitcoin, and investors can purchase them just like they would any other stock. No crypto wallet and no exchange. These ETFs are an absolute game changer because when investors decide to put money into the ETF, well, the fund has to go and buy real Bitcoin. So that means more ETF inflows means more buying pressure right onto Bitcoin's chart. And if investors decide to take money out, well, the opposite happens. So, for the first time in history, Bitcoin is being driven by something other than its own natural supply cycle. And that is institutional capital, which is moving in and out of the markets now every single day through these ETFs. That's why throughout 2025, investors started asking some new questions. Instead of wondering how many months since the last Bitcoin halving, they started asking questions like, how much money went into the ETFs today, and what does the Federal Reserve plan to do with interest rates? Bitcoin has finally started behaving less like a niche crypto and much more like a global macro asset, alongside others like gold, silver, and other risk assets. But suddenly there came another twist. By mid-2026, US spot Bitcoin ETFs had seen several $billion in net outflows. That's billion with a B. And at the same time, Bitcoin pulled back sharply from its late 2025 all-time highs. This reignited one massive debate. Is this just another correction like we've seen in all the other previous cycles? Or could this time be different and it's proof that the market has fundamentally changed? Well, there's two sides to the story: the bulls and the bears. On the bull side, they believe that the Bitcoin bull market is still fully intact. We're talking firms like Fundstrat, Bernstein, Standard Chartered, JP Morgan, and even the Ripple CEO Brad Garlinghouse. They argue that institutional adoption is still in its very early stages. Their view is really simple. They believe that short-term ETF outflows are totally normal, but they also think that over the long term, pension funds, asset managers, and corporations plan to continue to allocate capital to their Bitcoin reserves, therefore greatly pushing up the price of Bitcoin. The bears, on the other hand, are much more cautious. Crypto Quant, for example, has argued that demand growth for Bitcoin has slowed so much that we might be entering an extended bear market. Veteran trader Peter Brandt has also said that a major technical breakdown could send Bitcoin prices spiraling much, much lower. And finally, from my research, I noticed that Bloomberg intelligence strategist Mike McGlone has warned that tighter liquidity worldwide and slowing economic growth around the globe could pressure Bitcoin alongside other risk assets. So, what should newer investors actually take away from all this? Well, not a prediction, but a framework. First of all, if ETF flows are actually becoming more important than the Bitcoin halving itself, well, then those are the numbers we need to start paying attention to. Daily ETF inflows, Federal Reserve policy, and overall market liquidity might actually be telling us more about the demand for Bitcoin than simply counting the months since the last Bitcoin halving occurred. Secondly, risk management, that matters more than ever. When respected analysts are split between new all-time highs and a much, much deeper correction, that means nobody knows what's going to happen next. Which is exactly why position sizing is often going to be way more important than actually timing that perfect market bottom. So, is the Bitcoin 4-year cycle dead? Well, probably not, but it's also not the whole story anymore. Sure, the halving still reduces supply, but today Bitcoin is also influenced by ETF flows, institutional adoption, interest rates, and of course, global liquidity. In other words, the market has become much, much bigger and much more connected to the traditional finance system. And that means the old playbook that we used to use, following the halving, that might not be enough on its own anymore. As always, guys, remember, nothing in this video is financial advice. I'm definitely not a financial advisor, just a guy on YouTube who's using publicly available market data and analyst research. And guys, crypto investing, especially when using leverage, carries significant risk. So always make sure to do your own research before you consider investing. If you enjoyed this breakdown, make sure to subscribe below for more macro-focused crypto analysis every 2 weeks. And next time, we're going deep under the hood to learn more about how ETF creation and redemption actually works, and why that mechanism is the reason these daily flow numbers probably are going to tell us more about Bitcoin demand than the actual price candles do. And by the way, if you've been wondering why I keep bringing up ETF, well, the next video is going to be for you. So, see you there.